How is everybody doing? Welcome back to another episode of The Banker Next Door. I'm your host, Dr. Joe Berquist. Today, we're going to be talking about an article from the Wall Street Journal. Basically, everybody remembers collateralized loan obligations, CLOs. Remember commercial mortgage-backed securities, residential mortgage-backed securities, asset-backed securities. If you ever saw the movie The Big Short, the Michael Lewis classic on the 2008-2009 financial crisis, well, all those things that led to the 2008 financial crisis, they are back, baby, and they are back big time. And this is the article here that we're going to be covering today about this topic. So this article from the Wall Street Journal was called "They Crashed the Economy in 2008 and Now They're Back and Bigger Than Ever." Wall Street expects to sell more than $335 billion in asset-backed debt this year. Remember that conference in The Big Short? It just drew a record 10,000 attendees. So yes, if you remember toward the end of The Big Short, they had all the characters kind of assemble in various ways at this big conference out in Las Vegas. And that's basically where we kind of pick up here. So the convention hall at the Area Resort and Casino in the Las Vegas Strip were packed for 4 days this past week with bankers and their clients in uniforms of Italian sport coats and office sneakers. They fist bumped greetings as they strode to their next meetings, giving off the feel of a joyous reunion. The hotel's Sky Suites were booked. Citigroup bankers set up more than 900 meetings. A panel on data centers was so popular, attendees sat on the floor. Bank of America arrived with clients it had just taken on a ski trip to Park City, Utah, at 10,000 people. It was the biggest ever SF Vegas, the annual gathering for the structured finance industry. The last time it boomed like this was 2006 and 2007. Mortgage bonds were selling like crazy, and this crowd was flying high. Then these financiers crashed the U.S. economy and sent the global financial system to the brink. Now structured finance is back. Wall Street is once again creating and selling securities backed by everything. The more creative, the better, including corporate loans and consumer credit card debt, lease payments on cars, airplanes and golf carts, and payments to data centers. Once dominated by bonds backed by home mortgages, deals now reach into nearly every cranny of the economy. It's amazing to see, says Leslie Goldwasser, a managing partner with Greensledge, a boutique investment bank that focuses on structured credit. I have watched this with absolute wonder. The new U.S. issuance of some of the most popular flavors of publicly traded structured credit hit record levels in 2024 and are expected to surpass those tallies this year, according to S&P Global. New asset-backed securities totaled $335 billion. Last year. Collateralized loan obligations, or baskets of corporate debt, rose $201 billion, also an all-time high. This week's event boasted more than 3 times the number of attendees than the World Economic Forum in Davos earlier this year, and nearly twice what the Milken Institute's global conference brought to Beverly Hills last May. This is the conference made famous by Hollywood in the 2015 movie The Big Short. In the early 2000s, Americans, even those with poor credit scores, were buying homes in droves and getting mortgages from banks with features like no down payment. Banks packed up those loans and sold them on to investors who made huge bets that homeowners would never default. But the financial machine powered the boom broke down when real estate prices fell and credit markets froze, leading to the demise of Wall Street firms like Lehman Brothers. Other banks got government bailouts. Today, big investors want to buy these types of securities because they think they are relatively safe and yield more than government-backed bonds. Banks are mostly middlemen because regulations instituted after 2008 curtailed their lending. That has opened the way for giant fund management companies like KKR, Apollo Global Management, and Ares Management to muscle in and make loans with their own capital. And this is where private credit comes in. And this is what the big thing here. We're gonna look at this in a minute. So look at this chart for a second here. Let me see if maybe I can blow this up for a second, make this a little bit bigger for everybody. Okay. So this is new issuance of select security types. So we have collateralized loan obligations here in the gray. We have commercial mortgage-backed securities as kind of like light, what would you call it? Almost like a light orange, light pink. And then we have residential mortgage-backed securities, a little bit darker, and then asset-backed securities, which are the darkest red here. So we see asset-backed securities kind of taking up the biggest chunk here, followed by residential mortgages and then consumer mortgages, and then collateralized CLO, collateralized loan obligations. But the forecast here has this going up to over $2 trillion, which is just, astronomical. So Goldwasser has been to the annual Vegas event for at least 10 times. She was working at Bear Stearns in 2008 when it nearly collapsed and was sold to JP Morgan. I lost my firm, my job, she said. A lot of people blamed us. Yes, I think that's a fair blame. Notice she didn't say, we messed up last time and we're trying to do better this time. No, she didn't say that. She just said a lot of people blamed us, meaning that she didn't feel like the blame should have been attributed to her or her firm in any way. Goldwasser and Greensledge, which she joined in 2013, advise and arrange structured credit deals. It's like old home day, she said about the conference. I walk down the corridors and bump into all these people, old friends. The business came back, Goldwasser said, because a lot of securitized debt has performed well over time and proved useful to smaller companies in search of cheaper financing. It's the great equalizer of finance, she said. Really? Chris Flanagan, Bank of America's top securitization analyst, arrived at this year's conference looking more like a movie studio executive than a banker, wearing jeans and a black t-shirt and sports coat. He was fresh off a ski trip in Park City with clients looking for his take on the markets. He led a panel discussion of ABS bond traders. And originally an electric engineer, Flanagan switched to mortgage bond analysis in 1986, looking to make more money off his number crunching skills. He's excited about the market's revival. Sales of securitized debt have been surging since the COVID-19 pandemic, when the Fed lowered rates and investors were awash with cash and looking for investments. Flanagan said, everything is going to end up here, he said. So once again, what happened in let's go back. Let's take a step back for a second. In 2000, you had what? You had the dot-com bubble burst, okay? That led the Fed to lower interest rates. And then Alan Greenspan, who was the chairman of the Fed at that time, kept rates artificially low for too long, thus igniting the real estate boom. In other words, capital is going to flow. It's going to flow into areas. Like if it ain't making money over here, it's going to flow over here. So if you can't make money in stocks, the logical place, you're going to go into real estate. So all the money flowed into real estate. Rates were super low. Capital's cheap. So boom, you had, and that's where everybody was putting their money. And so then the Fed artificially inflated all that, but there was more reasons there that we could go into. But the Fed was the primary driver of it again, and then it blows up. And then what do we see here yet again? COVID happens, and then the Fed pumps the market full of money, drops interest rates all the way down. And then, they ignited inflation, but then they also ignited this. They ignited this debt boom. Obviously creating what is going to be inevitably another debt bubble, where but I called it, but right now we have what I call the everything bubble. There's not a bubble in any one thing; it's a bubble in everything. So everything is going to end up here, he said. So that includes debt backed by money tied to artificial intelligence, solar energy, and even payments from plastic surgery patients. Bonds backed by leases on data centers and fiber optic networks, which power companies' AI operations, hit $4 billion in the first 2 months of the year, equivalent to 1/3 of total issuance in 2024, according to FinSight. One of the hottest topics of conversation at the conference was the wave of money coming from investment firms doing their own massive private securitization deals. Oh, how interesting. Ares Management is part of the new wave. It started in 1997 as a fund manager focused on private equity and junk bonds, and now has $484 billion of assets under management. Almost 10% of that money is invested in private ABS. Felix Zhang, 35, who was a sophomore at Harvard in 2008, is the senior partner Ares sent with a 20-person team to the conference. Oh, that's nice. Formerly an investment banker at Goldman Sachs, Zhang joined Ares in 2015 to help boost its private ABS business. He was part of an exodus of ABS investment bankers chased out by tighter regulation. Back then, he and two colleagues would show up in Vegas and spend most of their time trying to pitch their vision to potential business partners. It became an easier sell by 2019, he said, after Ares and other fund managers had bankrolled increasingly large deals backed by assets like auto leases and aircrafts. It's nice not having to explain to people what I do anymore, Zhang said. Oh, isn't that great? This past week, Zhang, in green socks and Gucci loafers, held court from one of Ares' Sky Suites, assessed via their own elevator banks. A stream of borrowers, investors, bankers, and lawyers made their way up. Ares broke up its back-to-back meetings by ordering in from In-N-Out Burger. Oh, isn't that awesome? Law firms, software, and data companies, service providers, and mid-sized banks rented booths in an exhibit hall as big as an airplane hangar. They handed out phone chargers, Rubik's Cubes, lint brushes, and other swag, all hoping to catch the eye of some of the multi-billion-dollar investment managers passing by between meetings. The longest lines formed around booths offering a virtual golf driving range, massage, and opportunity to cuddle with emotional support dogs. What? Jason Pan, an analyst at PGIM, the investment arm of Prudential Financial, came to the Ares to talk on a panel about data center ABS. It was so popular, people had to sit on the floor. Data center bonds are backed by lease payments from companies that rent out computing capacity. It will cost about $3 trillion to build the centers needed in the next 5 years, according to BlackRock. That perspective had many at the conference giddy with excitement. The growth feels exponential right now, said Pan, a 34-year-old former actuary and recreational rock climber. Pan says he is wary of over-enthusiasm in the market and is careful about which bonds he buys. He has become a heavy listener of esoteric podcasts like Data Center Hawk to stay up to date on the industry. Investment banking attracts the whizzes with social skills. The fixed income markets draw more STEM majors than stock investing. Structured finance is the even more intense, proudly nerdy corner of that debt world. Earlier in his career, John Wright worked in a structured credit group that colleagues nicknamed Team Dungeons and Dragons. Wright, now global head of credit at Bain Capital, said the conference's pop culture moment when it was lampooned in the movie The Big Short was pretty accurate. There was, he recalled, an army of people in blue blazers wearing lanyards around their necks. After the 2008 financial crisis, banks scrambled to unload what many considered toxic assets. One day, a banker called Wright to see if he would be willing to bid on an asset-backed security his firm was eager to unload. Can you buy it at zero? The banker asked. He was serious. By the time Wright returned with an answer, the banker had found another buyer. Still, Vegas is Vegas. By late afternoons, impromptu happy hours cropped up everywhere in the banks and funds' private quarters and in the exhibit hall booths. People spilled out of the Ares row of bars and lounges. Cocktail hours were followed by dinners at Jean George's Steakhouse and Carbone. The Ares Casino was humming at midnight. Investment bank Jefferies has helped structure some 180 ABS and CLO deals in the past 2 years that were syndicated to more than 300 investors. The sizes of those transactions have also grown. What makes this cool again, says Sassin Soleimani, who heads Jefferies' U.S. Securitized Markets Group and was also in Vegas this week. It's where the capital is being deployed right now and where new asset classes are forming. The buying and selling of securities is digitized and often automated, but business in the structured debt markets is still conducted by phone or over messages on Bloomberg terminals. On most workdays, bankers reach out to investors with a list of deals that will soon come to market. Because it's a bit analog, it has resisted automation, said Peter Walgren, co-head of capital markets arm of Jefferies' Securitized Markets Group and a panelist at this week's conference. Suddenly, this is an area of finance people want to work in. When Barclays' first-year analyst heard recruiting pitches from various leaders a decade ago, an investment banker touted the frenzied pace, long hours, and grinding work, and the stupid amount of money that they make. Don't leave that out. All right, so let's that's basically the end of it there. So here's my big problem with this whole thing. Number one, I see nothing that has changed in the last 16 years. Nothing. It's still the same. Like I said, I hate to say clowns, but it's still the same. I'll call it a clown show. It's still the same clown show. Still people, just everybody's looking to get mega stupid rich at the expense of everybody else. So greed rules, as it always has. And and this is concerning. This is highly concerning to me. And I have done other episodes on private credit. I highly suggest people check those out. Private credit to me is the next bubble. If somebody said to me, what is one area to think that the next bubble will come out of, I'm telling you right now, it will be private credit. And it will be all these hedge funds and these private equity funds that blow up, and they will be back. I guaranteed, as the sun will come up tomorrow, they will be back begging the Federal Reserve for a bailout. And the Federal Reserve will be all too happy to comply with the once again telling us all that if we don't bail out and save all the hedge funds, it will be the end of the economy as we know it. Our world will all come crashing down if a whole bunch of rich hedge fund managers and private equity people are out on the street. So again, I'm highly disturbed by this. But like I said, history is the barometer, right? History has taught us very important lessons, and history continues to teach these lessons, and people continue not to learn from them, as evident by this article that we just read. So, but with that being said, I will wrap up by saying, if you like this episode, please make sure to like, share, and subscribe. Please leave your comments down below. I'd love to hear everybody's comments on this one. Remember, we are on YouTube, Rumble, and all major podcast platforms. And please be sure to check out some of the other content on the channel. Maybe those episodes I did on private credit, maybe, just maybe. But all right, whatever. I hope everyone has a wonderful day out there, and I will see everyone again real soon. Take care.